The labor market is one of the fundamental components of any economy. It determines household incomes, levels of consumption, and the overall pace of economic development. In public discussions, three key terms are frequently used: employment rate, unemployment rate, labor productivity. These indicators sound straightforward, but their interpretation is often oversimplified. For example, low unemployment does not always mean a strong economy, and rising unemployment does not always indicate that economic conditions are worsening. To understand these concepts correctly, it is important to examine how they are defined and how they are interconnected. Let us begin with employment. Employment refers to the number of people who participate in the production of goods and services. The employed population includes wage and salary workers, business owners and entrepreneurs, part-time workers. However, the employment rate alone does not describe the quality or strength of an economy. Two countries may have the same level of employment while having very different levels of income and prosperity. The reason is that economic performance depends not only on the number of people working, but also on the value they create. Example: in one country, most people work in sectors characterized by low productivity, labor-intensive manual work, low levels of automation, limited technological development. In another country, a smaller share of the population generates significantly greater economic value thanks to advanced technology, capital investment, education and skills, efficient organization of production. Formally, both countries may have similar employment rates, yet their economic outcomes will be very different. Now let us turn to unemployment. In macroeconomics, unemployment has a precise definition. A person is considered unemployed if they do not have a job, are actively looking for work, are available and ready to start working. This is an important distinction. Not everyone without a job is classified as unemployed. For example, students, retirees, people who have stopped looking for work may not be part of the labor force at all. The key factor is active job searching. This means that unemployment statistics do not include everyone who is not working. They only include those who remain active participants in the labor market. This leads to an important implication. If a person stops searching for work, they may no longer be counted as unemployed. As a result, the unemployment rate does not always provide a complete picture of economic conditions. Why does unemployment exist even in stable economies? In a market economy, a certain level of unemployment is considered natural. This is because the labor market is constantly in motion. People change jobs, people relocate, people pursue education and training, people move between industries and occupations. As a result, even in stable economies, there is always a portion of the population that is temporarily searching for work. In macroeconomics, unemployment is usually divided into three main types. 1. Frictional unemployment. This is temporary unemployment related to the process of finding a new job. For example, a person changes companies, moves to a different city, or graduates from university. Frictional unemployment exists even in strong economies, and a certain level of it is considered normal. 2. Structural unemployment. This type occurs when the structure of the economy changes. For example, automation replaces certain jobs, or the economy shifts from industry towards services. As a result, workers' skills may no longer match what the labor market needs. This is one of the key challenges of modern economies. Technological progress simultaneously creates new professions and eliminates old ones. 3. Cyclical unemployment. This is unemployment caused by an economic downturn. During a recession, aggregate demand falls, production decreases, and companies start laying off workers. Cyclical unemployment is the most closely linked to the economic cycle. It is also the type of unemployment that governments and central banks try to reduce through monetary policy, fiscal stimulus, and measures aimed at supporting economic demand. Let us look at how unemployment is connected to inflation. When unemployment is low, companies find it harder to hire workers. As a result, they start increasing wages to attract labor. If productivity is growing slowly, but wages are rising quickly, business costs increase. Companies then pass these higher costs on to prices. This creates inflationary pressure. That is why central banks closely monitor the labor market. The labor market is one of the key channels through which inflation is formed. In macroeconomics, this relationship is often explained using the Phillips Curve, an idea describing a short-term trade-off between unemployment and inflation. Now we reach the most important part. Because in the long run, the main source of economic growth is not simply employment, it is productivity. Productivity shows how much an economy produces from a given amount of resources. It is one of the most important indicators in all of macroeconomics. This is because productivity determines real wages, long-term GDP growth, and the standard of living. A country cannot continuously improve living standards if productivity is not growing. What increases productivity? There are several key factors that drive productivity growth. 1. Physical capital. Machines, equipment, infrastructure, and technology. Better tools allow workers to produce more. 2. Human capital. Education, skills, and experience. The higher the level of human capital, the higher labor productivity becomes. 3. Technological progress. Technology is the main source of long-term economic growth. The internet, automation, artificial intelligence, and robotics all increase production efficiency. 4. Institutions. Property rights, effective courts, competition, and a stable financial system. Without strong institutions, an economy cannot efficiently accumulate capital or foster innovation. Why does productivity determine national wealth? If we compare rich and poor countries, the main difference is often productivity. A worker in a highly productive economy creates much more economic value per hour of work. That is why real wages are higher, tax revenues are larger, and living standards are better. In fact, the entire long-term history of economic development is a history of rising productivity. From agrarian economies to industrial economies, from industrial economies to digital economies. Today, the labor market is entering a new era. Artificial intelligence are changing the structure of employment. Some professions will disappear, while others will emerge. The main challenge of the 21st century is adapting the workforce to technological change. That is why the future of the labor market increasingly depends on education, retraining, economic flexibility, and the speed at which institutions can adapt. So what is the relationship between these indicators? To summarize, the labor market can be described through three interconnected elements. Employment shows people's participation in the economy. Unemployment reflects temporary or structural imbalances. Productivity shows how efficiently economic value is created. Together, they provide a much more accurate understanding of the state of the economy than any single indicator alone. If you enjoyed this video, subscribe and stay with us. In the next video, we will cover GDP, GNP, inflation, and deflation, their meaning and methods of calculation. See you in the next video.